Can you tell us which of these stocks or companies is going to tell us the most about the American consumer?
I think we can get a little bit of something from each of them in terms of what's happening with the American consumer. Today with Home Depot, you're going to get about the home, and we're going to have TJX report about off-price today. So we certainly saw value and convenience mean something last week at Walmart. I think we're going to get a similar reading at TJX this morning. And let's not forget Kohl's, because we're going to get that this morning also. They put in Amazon returns right before Amazon Prime Day. So are they getting that increase in traffic that's boosting attachment sales is what we'll see. And then we're going to get apparel retailers, Urban Outfitters, Gap, L Brands, which all have work to do in terms of managing margins and do they have the right product that's going to attract the consumer. We have a very iffy time with second quarter earnings, and I think earnings guidance for the most part will be adjusted lower, not higher.
All right, so let's talk about all the cross currents you spoke about. There was a time I remember in the past when we used to say if you saw strength in retailers like Walmart, strength in retailers like Dollar General, Family Dollar, Dollar Tree, those types of stores back in the day, that told you a certain economic narrative. Is that something that you're seeing playing out right now, that people are moving a little bit more towards the off-price / value categories and less away from the top?
I am. That is exactly what I'm seeing. I'm definitely seeing value, convenience means something to the consumer today. That's even more. I think overall there's more choices for how consumers are doing discretionary shopping. Rental, subscription, consignment are all alternatives, and traditional boxes like department stores are getting into these new businesses, while specialty stores are all fighting for that newness and innovation. Denim customization studios, personalization efforts, figuring out a way to differentiate.
Analysts at J.P. Morgan say that this latest round of tariffs, when they go into effect September 1st, and certainly the ones that have been postponed until December 15th, are going to hit the consumer harder than the previous rounds have. They think it's about $1,000 more per average American household. How important are these tariffs, and what relative effect will they have on certain parts of that retail spectrum? Who's going to be impacted the most among the retailers you cover?
When I think about this tariffs that's coming into play, it could be some of the dollar stores, given that they import a lot of goods from China. It can be some of the apparel companies and the footwear companies, given that it's estimated that in excess of 70% of some of their goods come over from China. And companies have three things they can do: diversify their sourcing beyond China, which they're all in the midst of doing, sharing the costs with some of the manufacturers in China, and that's happening, and then pass on a price increase to consumers. We heard that Macy's tried to pass on some of the price increase in the furniture category last week, and it didn't take hold as much. So consumers are going to keep looking for value. Off-pricers offer value because they're typically at least 20 to 60% price below what some of the full price in department stores may be. We're concerned, and we agree that it is a tax on the consumer.
So Dana, let's talk a little bit about that consumer, because the main crux, if not the main crux, one of the main, I guess, legs that this economy stands on is the American consumer. The retail data right now still says the consumer is strong. It's one of the main reasons why the Trump administration is saying the economy is healthy. The consumer is there. Do you see any signs there that would justify that claim, or are there pending signs of weakness ahead that might lead to a possible recession down the line, like some parts of the bond market are telling us?
What we're concerned about, think about what you have with tourism. Macy's just called out a 9% drop in tourism. We heard about Ralph Lauren and some of the other companies talking about weak tourist trade. We're seeing some build in inventory levels. A build in inventory levels will lead to more promotions. With the consumer having low unemployment, wages rising, they're in a solid position. They're choosing to spend their dollars on experiences and activities rather than goods. And if there's going to be higher prices coming, the ability for a solid holiday season remains in question, especially since we have 6 fewer days this year between Thanksgiving and Christmas. I think the second half of the year is more of a push than it's been in the past.
Given that outlook, Dana, are there certain companies that you gravitate towards in terms of stock returns and ones that you stay away from, knowing that you have that outlook for the you as a consumer?
I want to be defensive. I want to be defensive because I want to have companies that can price competitively and that offer that convenience and value. I think you can have certain brands which have appeal, and you'll have that at the highest end luxury goods. And then you're going to have the value offering like what you see in the off-pricers. And that is companies like the TJXs of the world. I also think the Walmarts of the world will continue to play and look at the traffic that they're gaining. I think that's appealing. And then you have companies that have been beaten down, like an American Eagle Outfitters, that have been down over 20% in the past 3 months. And we think their concepts like Aerie on the intimate apparel side have value. So looking very carefully at specific company factors that'll lead to growth in the back half of the year and into 2020.